Thanks a lot for that, Vivek. Dipan Mehta, Director at Elixir Equities, joins us on the show. Hi, Dipan. Good afternoon. Thanks so much for joining in. Any view on the current listed stock? That's BEML. The hope is that, obviously the stock is higher. The hope is that the divestment goes ahead. And, already the land assets have been now separated. So if you could give us the view on the stock around 1,200 rupees and any value you're assigning to the company that will list tomorrow, which houses the land assets?
Yeah, Raja, thank you for having me on your show. Actually, BML has just fallen through the cracks over years. The performance has been so mixed over the past several years or so, and it's not created any great value. Even when other PSU stocks were adding, this has been a bit of an underperformer compared to that. So not really tracking it, and I have no idea what the fair value of the land holding would be. But yes, I think if privatization does take place, then that would be really a big trigger for BML. We have seen that change of management at the public sector company going from public to private. Eventually, just capture the kind of attention of investors, and you could see the stock rallying even further from these levels. On a more broader basis, because we are seeing an upcycle in CapEx, I think BML should be pretty well placed and should be able to garner more orders. But as a PSU, it has been a bit of a disappointment.
Okay, all right. Well, before we move on, just pull up the intraday chart of AMI Organics. I pull up a month-to-day chart as well. AMI Organics has been moving very, very well. And today as well, the stock dipped a little bit, but it's moved to the high point of the day. Last 1 month or so, the stock is up close to around 15%. Some of these companies have not been able to scale up in terms of revenues. Let's see whether Q4, the street is counting on Q4 being good and margin improvement as well. So let's see whether or not that does take place. For the time being, the stock is higher. But the one that's struggling today is Tata Chemicals. And we go across to Dipan to get his view on that. Kotak has written a note. They point out that the company has taken a 3 to 4% price cut in soda ash, both light and dense soda ash, effective yesterday. Now, the cut comes because prices have been, falling prices in China since mid-March. Not just that, there is additional capacity that could come on stream in Mongolia from May 2023. So ahead of that, they're seeing, the soda prices being corrected. Besides the prices, the problem is also in terms of demand. That needs to be monitored. To give you a number, soda ash as a percentage of the total consolidated EBITDA number is close to around 15 to around 20%, which will get impacted. Now, the price cuts, it could be partially, mitigated because coal prices are lower. So that's what they point out. And they're saying Q4 earnings, no worries. They have a problem with the second half of this calendar year that earnings could come under pressure because of this correction in prices and also highlighting demand out there. Dipan, what's your view? Tata Chemicals, yesterday in the final hour of trade, the stock took a sharp downtick. It was down close to around 2.5 to 3%. And today, it started off with a bit of a mild cut, but now the street is clearly cautious because as we speak, it's down a good 5%. Your view?
That's what happens, Nigel, with commodity stocks, that prices go up, prices go down, and that does impact the sentiment and the near-term performance. But Tata Chemicals is, I think, relatively attractively valued, point number one. And secondly, they are trying to move up the value chain, and they're trying to capture all the chemical opportunities which are there on the EV space as well. In fact, Tata Chemicals is one of the key companies in the Tata Group when they try and build an entire electric vehicle ecosystem in terms of chemicals and technologies which go into building a lithium battery or any other similar battery which will drive electric vehicles for Tata Motors. So I think that the medium to long-term outlook for Tata Chemicals is very good given the valuation which is trading at just now. Short-term, you may have to take a bit of a knock as far as quarterly numbers are concerned. But as I said, I think that going to move up the value chain, new capacities and specialty products are being ramped up. And you may have a soft quarter or two, but just based on that, I would sell off Tata Chemicals, given that a larger opportunity exists in some of the other products which are in kind of a scale-up mode.
Another big mover today is Just Dial. That's surging in trade, and the numbers look good. 5% quarter-on-quarter revenue growth, 40% on a year-on-year basis. Margins at a 2-year high, and the management has also guided that margin improvement will continue going ahead. And he also indicated that they're open to the idea of using the cash balance for inorganic moves. Listen in to what the management had to say, and then we'll get a sense of where the stock is headed from Dipan.
as we move forward into fiscal 24 and as our revenue converges with our collections for this year, this margin should sequentially keep on seeing an uptick, which is visible in last 2 to 3 quarters as well. So on a long-term basis, I think this business requires 6 to 7% of our top line to be spent on advertising. It could fluctuate a bit on a specific year basis. For coming year, I think anywhere around 35-40 crores definitely we would want to spend. And further increases could depend on how things are panning out.
Dipan, Just Dial has gone through a very rough, 2 to 3 years. COVID really impacted their SME clients, which in turn impacted the revenues of Just Dial, margins as well. But do you think the worst is behind now? And Just Dial is looking attractive. Ultimately, they do have Reliance as a promoter, and there would be long-term synergies with the two businesses together.
You're right, I think. And if you've seen, the stock prices really started turning around and moving up since the change of ownership has taken place. And, with the Reliance management coming into place, you can expect more aggression, maybe newer products and service lines as well. But the biggest advantage of Just Dial is the kind of number of feet they have on the street and the kind of marketing network and team which they have. And again, they tend to build over there. Also, I think the overall trends in the advertising spend where MSME and SME advertising spends are going up will certainly benefit Just Dial. And another company that comes to mind is IndiaMart Intermesh. I think that also has been underperforming last several quarters. But both of these companies, I think, should start to do much better from this quarter onwards. The business is basically very high operating costs, so revenues when they start to grow, a lot of it finds its way into the bottom line. Valuations are reasonable for Just Dial considering the cash which they have on their books. The only real concern is that Just Dial was trying to get into the B2B space, which is dominated by IndiaMart. And I'm not sure they made adequate progress over there. At the same time, they were trying to get into e-commerce, actually getting into buying and selling of products, connecting the buyer and seller and routing it through their portals, but that also has not worked out. So end of the day, they still remain a kind of a B2C advertising, a yellow pages type of a business. And that at some point of time would have reached maturity. So it's a bit of a mix of positive and negative. But for the time being, I think looking at the numbers, you could see a further build-up and stock moving even higher from these levels.
Dipan, so just to add on the 2 points, one is their B2B business, which they call JD Mart, which compares with IndiaMart. We asked the management, how it's doing, and he's saying that it's actually been a big growth driver. Last year, it contributed 26% to their overall revenues, and B2B revenues is growing faster than B2C. On that second point that you said about e-commerce, they call it JD Shopping. And I think they're going slow on it because what the management told me is that they're still evaluating the unit economics of JD Shopping. So they're not yet pressing the pedal when it comes to JD Shopping, but their B2B business appears to be picking up, though it's still dwarfed by their B2C business. But do stay on, need to get into a break. On the other side, we also have our Alpha Manager of the Day, Aman Chauhan of Abacus Asset Management waiting by.
And benefits. Experience the best. Discover a world of banking possibilities with Canara Bank API Banking. You deserve the best. Canara Bank, together we can.
Welcome back. All about earnings. That's what this market is at the moment. And we are continuing with the analysis. Looking at Schaeffler, the stock is down actually about 2% The numbers looked okay. We have Sonia joining in with the fine print. Sonia, what's the key takeaway?
Actually, the numbers have slowed down quite a bit. If you look at it, both the revenue and the EBITDA growth has been in low single digits this time around. And it's lower than what some of the street was expecting. So if you look at it, the revenue growth was barely about 8% year on year. The EBITDA growth was just around 2% on a year on year basis. And the margins, in fact, have fallen 110 basis points on a year-on-year basis, coming in at 18.6%, barely a profit growth as well of around 6%. The management, in fact, speaks about how there are some external challenges that they are facing, and despite that, it has been a resilient performance from them. They say that the automotive technologies and the automotive aftermarket business has registered a strong year-on-year growth, but this is, because of their own operational efficiencies that has helped them mitigate the external headwinds, resulting in resilient margins. So there are external headwinds that they allude to. They also say that they have taken cognizance of the volatility and the challenges in the market environment, and despite all of that, they are committed to continue their growth performance. So the management commentary is a bit cautious. The numbers are, it's just barely about low single-digit growth that they're seeing and below street expectations. Hence, the stock is under a bit of pressure.
Okay, got that, Sonia. Thanks very much for the details over there. Dipan, hi, good afternoon. Wondering if you've seen Schaeffler of late. Sonia's pointing out to some concerns around growth slowing down. Thoughts on the stock?
No, I think Schaeffler has done really well over the past several quarters and has created a lot of value, post all the restructuring. And I think that this may be just a transient phase for them, because if the overall economy is picking up and their real customer base, the automobile industry, the engineering industry, and overall industrial activity picking up, that augurs very well for Schaeffler. At the same time, I think they're pretty well placed in terms of competition. Threat from Eastern European countries and China has diminished significantly. And also the cost of imports of steel being the biggest cost for them. Those prices also have flattened out and on a declining trend. So I think this is a bit of a transient phase, and we should see better numbers coming through. One should look at the base effect also, which is coming to play over here. Valuations are on the higher side, but given the kind of consolidation that has taken place and the move to quality within the industry, I think this company can certainly, be at least a market performer, if not an outperformer.
Okay, all right, Dipan, stay with us. But the sector of the day and of the past 1 month has been the pharma index. Brokerage firms like JP Morgan as well as Citi, they're getting incrementally positive on the pharma stocks. Ekta joins us to run us through their reasoning for suddenly turning a little bit positive. Ekta.
Thanks for that. Well, I'll start with JP Morgan, which is written on the pharmaceutical space. They pointed out that the Nifty Pharma Index is up around 6% in the last 1 month, outperforming the Nifty. Now, 5 reasons according to them, which will drive the sector performance through the year, include the fact that the India business is likely to see the highest price increase this year, aided by one of the highest NLEM, which is the National List of Essential Medicines, revisions. Secondly, for price erosion trends, according to them, they are moderating in the US generics versus the elevated levels that we've seen in the past 2 years. They also see opportunistic gains in US arising on account of increased drug shortages and supply disruption. They are also positive on the fact that there are easing input costs, freight cost normalization, which should aid margins. Sector valuations, according to them, are reasonable at this point in time. The top picks for JP Morgan are Sun Pharma, which has a solid domestic franchise, according to them, and their continued ramp up in specialty. Cipla, continued outperformance in the India business is one of the reasons that they like that particular stock. Citi has also ridden on the pharmaceutical space, but they are striking a cautious note. According to them, the current optimism around the US generics pricing may in fact be short-lived. The biggest reason behind the continued pressure on generic pricing is factors such as aggressive scale-up by small and new entrants in the US generic space, which remains unabated. They maintain a cautious stance. They maintain that Sun and Torrent are their preferred picks in the Indian pharmaceutical space.
Ekta, thank you very much for that. Dipan, which one would be your top pick in the pharmaceutical space, including healthcare, diagnostic, across the board?
Well, I think Ekta has all smiles after a very long time, because pharmaceutical reporting disappointing numbers time and again for several quarters, and now finally there is some positive news on the horizon, so that's good. But I don't really like the space very much, because it has got highly commoditized, at least the export business, be it in US, be it elsewhere in the globe as well. And really the actual value building is in the domestic pharma business, where brands actually still matter a lot. So keeping that in mind, we would like to remain underweight in most pharmaceutical companies. They're a very, very attractive valuation, no doubt, but that kind of a straight line secular growth is not visible anymore. But the favorite stock still remains Sun Pharma. Completely appreciate their strategy to move up the value chain by launching specialty products. I think they are again over here ahead of the curve, and you will see many other companies follow what strategy they are doing at present. But by then, I think Sun Pharma would be miles ahead. And if this strategy is genuinely successful and it becomes a major part of their revenues, then you could see a re-rating of the P multiple of Sun Pharma and a greater degree of stability and growth in earnings as well. So that's the only company that really we are tracking. And I heard about Divi's Lab earlier as well. I think we could see a turnaround over there because that's also another solid quality player. And eventually, I think the value proposition is very strong what Divi's offers. And it's just a matter of time before their custom synthesis business starts to pick up, and that's very high margin value add.
Okay, all right, got that. Dipan, always a pleasure speaking with you. Thank you very much for all the perspective on the stocks that we have discussed today. Have a good afternoon, and we'll